Sandeep Jesha joins us, Chief Executive Officer with Sampriti Cap. Sandeep, good morning. Thank you for joining us. Sandeep, if I look at the Nifty 50, large cap stocks are holding on, but the minute I turn my attention to the mid cap index, to the small cap index, things are looking slightly shaky. So we clearly are staring at two markets.
Oh, absolutely. I absolutely agree with you. This has actually been a recent phenomenon. In fact, if you, however, looked at back in as close as December, we actually saw that the broad market actually outperformed the major indices, and that's because there was perhaps a better sentiment in terms of expectations of how the market would pan out. We've historically seen that markets tend to be a little choppy, and there seems to be a little. We've often seen tops happen just before the budget, which is obviously in the first half of the calendar year, first quarter of the calendar year. We've had a lot of positive news flow, right? We've had the government saying that they're looking to increase diesel prices by 50 paisa every month, till such time that diesel prices are in line with international prices. However, the market, of course, doesn't believe that. If you look at the prices of the oil refineries right now, they're saying that we're unlikely to see perhaps anything more than 1 or 2 diesel price hikes. Remember that the first major election is actually in May, which is actually the Karnataka state elections. The Northeast elections, which will happen a few months before that, are perhaps not so relevant. So the market's saying that we might see 1 or 2 diesel price hikes, but not significantly. So the point is that, as we get into the budget, there is a tendency for profit taking, and that's really what's happening at this stage. But I think this is an interesting time to actually take stock and look back in perspective. This current bull run has actually lasted for about 13 months. And if you differentiate between multi-year bull markets, like we saw in 2003 to 2007-8, and the kind of bull runs that we saw in 2010 and even in 94 and 96, the biggest differentiator, surprisingly, is actually retail participation. And retail participation is also linked with, all sectors of the economy firing and working out. Now, we have seen, if you look at, I have often differentiated the market between, the consumer and the industrial side. Of the industrial side, the interest rate sensitives like property and autos have actually done reasonably well. But if you look at, capital goods, infrastructure, that still remains highly depressed. And if you look at a vast majority of small caps and perhaps some of the mid caps also, even as the indexes, as Nifty is at close to 6,000, a lot of these stocks are 40–50% or even lower than what they were in 2010. So unless something can happen in this budget which will catalyze retail sentiment, which will catalyze the depressed parts of the economy into recovering, until such time, I think that, we will have to be a little careful as the market rallies, because these bull runs have really lasted for more than 15 months on average. That's not to say that they can't last a little longer, but I think that's the broad view. But I still maintain my view that the upside for the market remains, say, closer to 64 to 6,600, but the downside could even be 52 to 5,400.
At the current juncture, what is your portfolio strategy? Are you taking some chips off the table, or are you still fully invested?
Nikunj, you would recollect that we had given a buy at 44 to 4,600 in December last year, year before last actually, and also in May, June at 46 to 4,800. So given that, and given the fact that, though the finance minister has said that he was looking to keep the fiscal deficit under 5.3% for this year, bring it down to 4.8% this year, he says that the budget will be responsible. However, there is too much at risk here. There are significant profits which have been made in this market, and simply from a prudence perspective, simply from a risk management perspective, we have been recommending to raise cash, between 10 to 20%, at least, if not more. So that would be the strategy, to actually raise cash at higher levels as we get into the budget. And also, I think I'd also like to highlight that, I just briefly alluded to the fact that most bull runs have lasted on average around 15 months. And then either global or local factors have actually coincided to ensure that markets have corrected, and we've actually seen global investors selling. I'd like to, highlight the fact that, the market has been surprised by the negative, the decline in US GDP growth in the quarter that has been just reported. But, I'd like to highlight that, this is largely because of concerns about the fiscal cliff. And even though the market did rejoice that the fiscal cliff got partially resolved, the tax increases will still lop off about 0.5 to 0.75% of US GDP growth. And if you fully avert the fiscal cliff and we have further spending cuts, this is an important point. I think you might get another 0.5% cut in US GDP growth. So the global growth, though the tail risks in the global economy are not there in the system anymore in terms of what could happen to the euro region, but in terms of growth, there could still be negative surprises. So I think that's something, and I don't hear people talking about the fact that this could lead to lower GDP growth, and we're already beginning to see a bit of that. So there could be factors which we haven't really, plugged into our systems, which could impact the markets going forward.